Ladies, gentlemen, honored guests, and all those who are attending this conference today, welcome to Bank of Utah's Economic Real Estate Forecast and Economic Review for 2021. Can you believe it's 2021? It's amazing how fast time flies, but we're excited about it. We've held this conference for many years now in a live setting. However, because of the events of this past year, we had the opportunity to hold this event on a virtual conference, which makes it kind of nice because you can sit back, relax, listen to some great speakers, and really learn about what is happening in our economy. We believe that as part of our bank's duty, Bank of Utah's duty, is to keep our customers well informed of what's happening in their economic environment and in the communities in which they live. And to that end, we're honored to have some really great speakers with us today. Today we have John Walter and Neil Walter, the CEO and COO of NAI Excel. This company is a real estate company that's located all along the Wasatch Front and in Las Vegas. They have over 600 agents, and they're located right in our communities with 14 offices. So these people know what they're talking about where they live. They also manage over 2,000 properties in the areas which we have. So we have people well established and very insightful. They're also teachers too. And so you might hear more about that. And so I think we're really excited for what we have. But before we get started and turn the time over to them, I want you to please make sure all your devices are muted. We want to hear them very clearly. And if you have any questions, we actually have a chat room on this. So if you write down your questions on the chat room, towards the end of the meeting, we're going to ask the pertinent questions to them and they can answer as many as they can. And we're going to be done by 11 o'clock. We're committed to that. So without further ado, I'd like to turn the time over to John and Neil Walter. Thank you for being here.
Hey, thanks, Roger. We're really looking forward to this, and we're excited to be here with Bank of Utah and your clients and friends. And I think we are going to have a little bit of fun today, aren't we, John?
Oh yeah, we are glad to be here, and we really appreciate this invitation. It's going to be a great time.
All right, so Roger, we're going to jump right into this. Let me go ahead and get my screen shared here. So as a brief overview, this is some of the topics we're going to talk about today. So John and I are going to start with residential and commercial real estate markets from all along the Wasatch Front down to Las Vegas. And I'll just note that we think that Las Vegas is a really important tell because it's usually is a good signal for where much of the country is going, both with housing and commercial. And so we have significant operations along the Wasatch Front in southern Utah and in Las Vegas. And so we're going to provide that color and context, which may be of interest to you. Then we're going to talk a little bit about some of the population shifts that are driving these market conditions. And it doesn't matter whether it's commercial or residential real estate, population is the single most important driver to economic activity. We're then going to talk about stimulus and focus on some of the things that the government has been doing to really move the economy through COVID. And we'll talk about how those are impacting our local real estate markets. We wouldn't be doing justice to a good conversation on real estate, John, if we weren't talking about interest rates in this unbelievably low interest rate environment.
For sure. It's historical what's happening right now.
Yep. So we'll talk about interest rates. We're going to talk about asset inflation, and we intentionally phrase that asset inflation because much of our inflation metrics aren't capturing the price increases that we're seeing across assets in the economy. And then we'll wrap up with a forecast and a question and answer session. So,
Neil, before you jump into the residential side, I think it would be interesting for people to know that we have 12 residential real estate offices. Mm-hmm. So we're very much into the residential side of the business. We also have 3 commercial real estate offices, and all of them right across the I-15 corridor. The other thing that was mentioned is that we do a lot of asset management for our clients. And so we're looking at these things from a real estate perspective, consulting for our clients in the commercial, residential, and asset management realm. So I think with that, let's dive into the residential.
All right, let's do that. So first topic today is let's talk about some of the reasons why inventory, particularly in the residential markets, is so tight. One of the big reasons is people are just staying in their homes a lot longer. This is some national data here, but when we look at the length of time, or sorry, the number of people who have stayed in their homes for more than 20 years, that number is approaching 25%, which is really an extraordinary statistic when you consider that historically, leading up to the last recession in 2005, that number was below 10%. People are just very reluctant to move. The average length of stay in the United States in 2010 was 8.7 years. Today it's 13 years. And across the country, inventory is down 22%. Prices are up 15%. The average home price is $310,000, and there's 2.3 months worth of supply. So one of the things that's really interesting is when we look at residential markets, we know our markets in the Wasatch Front, in St. George are really tight, and people are aware of that. The thing that's is really interesting is that they're tight almost everywhere across the country. We'll talk about some exceptions a little bit later, but this is a set of market conditions that exist all over the place.
And I'll just add to that, it's been hard to move.
It is
because of a shortage of inventory, and it's continuing to be hard. And so when we look at how long people are staying in the homes, one of the reasons why is it's hard to find a place to move to.
Yeah, and I think if you talk to real estate professionals that are working with sellers, that's what their biggest concern. If I sell, where am I going to go? I have tons of equity. I may be really happy with the value that I can get out of my home, but I don't have a place I don't have a home to replace the one that I'm living in. When we talk about the inventory shortage, you can really see, if you look at, for example, Northern Utah month supply of inventory, we're looking at Salt Lake County, Utah County, Weber County, Davis County. Month supply of inventory has literally just collapsed. Same in Southern Utah, Sevier, which is Richfield, Washington County, Iron County, the Hurricane Valley. The month supply of inventory has collapsed in a way that is made it very, very difficult for buyers. It is more common than not for buyers to be in not just a multiple offer situation with a couple of offers, but they may have 5, 10, 15 competing offers. We're seeing some very, very difficult circumstances for buyers where prices are getting bid up substantially.
Just another thought on that.
Yeah.
I think people recognize that the markets of, Salt Lake County, Utah County, Washington County are experiencing this high demand.
Yeah.
But sometimes people aren't as familiar with these rural areas. And to your point, if you're trying to buy in these rural areas, whether it's recreation ground or whether it's a home or a getaway, it's extraordinarily hard, sometimes even harder than in these larger markets, relatively larger markets, right? Because there's so many people that are pushing that way.
And I think you can see that in this home value little table where we've summarized some key statistics. I mentioned earlier that across the country, home values are up 14 to 15%. And if you look kind of an average year over year change on a median home price, we're kind of in that range. You see a lot of 13s, 14s, 11s, right?
Mm-hmm.
But then you see Park City in Summit County up 28%.
Isn't that crazy?
And Beaver County, right? You were talking about the
Right.
rural markets where there's just an unbelievable amount of demand for a little bit of space, and in a small market, a small increase in demand really pushes those numbers. One thing that I would just note is really interesting as we've gone through and looked at all of this data. The number of homes that were built in 2020 is about the same as the number of homes that were built in 2019. And the number of homes listed in 2020 is about the same as the number of homes listed in 2019. The difference is about a 20% plus or minus increase in demand, which has created a significant amount of absorption and driven inventory down and prices up.
So we're not building less. It's not a supply issue.
Yeah, we just can't build enough to keep up with the increase in demand. So let's take a look at some commercial real estate market. We've got an office, industrial, retail, and multifamily sector that are having some of their own dynamics in this market.
Yeah, thanks, Neil. And they are all unique and different. And each market area is experiencing different dynamics as well. First of all, let's talk about office. This is an interesting one. Everybody is hearing all of the talk about work at home. COVID has had a significant impact on the way that people utilize office space. In fact, according to Statistica, 40% of office workers are working home 5 days a week, as compared to 17% in 2020.
That's a big shift.
That's a big shift. And I think you said that just right. It is a shift. It's not something that once COVID is over, everybody's just going to go back to the way it was. A lot of people might, but there's a fundamental shift in the way people are working in the office environment.
I'll tell you a statistic that really surprised me.
Yeah.
The Wall Street Journal was in a sort of way celebrating because office space in downtown Dallas had come up to about 44% occupancy.
That gives you to 44%.
That gives you an idea of what kind of a shift we're talking about, right?
Yeah, that's interesting.
As they're getting ready to essentially get rid of all the mask mandates and really just go back to normal in Texas, they're up to about 44%.
Well, and I'll tell you, just speaking to that, as of year end, the office market in Utah County went from about 6% vacancy up to 9% vacancy. And that trend's likely going to continue to go up. The key thing is how many people are, even though there's leases in place and people are quote unquote occupying the property, how many people are actually working from these facilities is a totally different story.
And I think when we're talking about the office market, it's really hard to predict what's going to happen because really we're waiting for a number of critical decisions from large employers, particularly the tech companies, to make decisions about what their long-term operating format is, how many people they're going to be bringing back into the office. And most of those decisions still seem to be not made.
That's true. I'd also indicate,
or at least not announced.
For sure. I'd also indicate that in the office market, there's a couple of different types of users, or at least you can put them in at least two buckets. One is where they're, to your point, the technology type companies, where they're not providing a lot of interaction with the customer directly. They're providing professional support services, in that type of environment. The other type of office user is one that is very much involved directly with the public. They're providing some kind of a service in an office environment. So frankly, banks, real estate companies, title companies have a high level of interaction still with their customers. Additionally, medical, you think of an optometrist or a practitioner. This type of office is not going to have a fundamental shift. The ones that are going to have the biggest shift are the technology companies and and the administrative professionals where they don't have a necessity to interact with the public in that type of way. So as we're thinking about the office space, one of the things about the Wasatch Front is there's a lot of tech office, and there's a lot of that type of users for space. And so it'll be interesting to see, to your point, what these decision makers do with their space long term and how that shift happens. Let's go ahead and jump onto industrial. In the industrial, it is unbelievable. All signals for the industrial market are strong. You notice office is some uncertain mix, and the industrial is strong in every single standpoint. So if you look at data centers, we have the Amazon and Google and Facebook data centers that are just exploding. We also have distribution, the Amazon distribution centers, different from the Amazon data centers, but you have the Amazons of the world that are continuing to take product directly to the home instead of being sold in a retail fashion. Construction, we talked about construction. It's at capacity. They're building as fast as can be built. And with some of the past regulations, we're seeing more manufacturing that's coming back to the US. And so the industrial market that a decade or more ago was kind of the difficult, undesirable industry is now the most preferred asset class of them all in a lot of respects. And so you notice this in the data, the industrial market's just strong.
Yeah, and I like to joke that industrial's the new retail. You know,
That's right.
Everybody was clamoring for retail because it was such a great asset class, and today all of the signals are pointing towards industrial as the the asset class of the future, because all the distribution is getting shorter and shorter and shorter. It used to be that we'd put some product on a truck in the port of Los Angeles and try and get it here within a couple of days. Now we need to have delivery in real time.
Yeah, it's immediate, right?
Mm-hmm.
So the industrial market is obviously going very, very well. Let's jump into the retail segment here. Again, the retail, you have a mixed dynamic in retail. The traditional malls, department stores, dine-in restaurants, movie theaters, the gyms, this entertainment concept, and this shopping center concept. You're seeing the news. These are struggling. We're having a higher level of vacancies. The expansion is slower, and COVID has really had an impact. I think the interesting thing to note is we had the Amazon effect and the virtual shopping, and then we had COVID come on top of it that really compounded. Retail was going to this experiential retail in a lot of these standpoints, and then COVID hit and really changed the experiential retail. One of the good things about the state of Utah is it's much more favorable to these types of businesses being open and allowing for shopping and allowing for going to dine-in restaurants and going to the gym a lot more than other states. But even so, there's been a significant impact, and it's created a slower recovery, a much slower recovery in the retail side. On the other side of the spectrum, though, you've got restaurants, grocery stores, a lot of these other types of retail that are really still doing extraordinarily well. Let's keep going and jump into multifamily here.
Yeah.
The multifamily market continues strong. The biggest question in multifamily is, will tenants continue paying rent? And in Utah, the answer is yes, they are continuing to pay their rent at very high levels. Our portfolio of assets is in the mid-90s on paying rent during the COVID pandemic, which is really
great. Yeah, really great results.
And there's been a lot of fear that they might stop or slow down, and that just hasn't been the case.
Well, particularly in Las Vegas, where they've had all of these moratoriums on evictions and made it very challenging for landlords. We're seeing hopefully some of that start to ease up, but it's been a tricky thing to stay in front of rents and collections through the last 12 months.
Yeah, vacancies have held low, construction continues high, rents have moved monumentally in the multifamily space, and it continues, like the industrial market, to have a pretty solid outlook. So that's kind of a summary of some of the commercial markets. As we kind of get through things at the end, maybe you'll have some questions. We can jump back to it if needed.
Yeah. So one thing we just want to highlight, we published two very detailed annual reports. One is published by NAIXL and NAI Vegas, covers office, retail, industrial, multifamily trends from the Wasatch Front to Las Vegas. And then in that same footprint, we publish the residential review published by ERA Brokers Consolidated. And it's that same footprint. All of the counties from the Wasatch Front down to Las Vegas. And what we're trying to do is really get our arms around what are the big trends, what's moving them, et cetera. So, John, with that, I think we need to start talking about why we're seeing some of the dynamics that we're seeing, right? I think that that'll be really helpful. So this is kind of the interesting part. So population shift is a big deal right now.
There's a lot of movement.
There's a lot of speculation and discussion about where people are coming from and where they're going, et cetera. And so when we start looking at populations, let's take a look at some really interesting data.
Neil, you use that word again. A trend is different than a shift.
Yes.
A trend is an up and down movement. A shift is literally a change in a fundamental dynamic. And that's what's happening here.
So before COVID, before March of 2020, these were the projections of the respective states. So right now we're looking at Salt Lake County and Utah County. We don't have enough room on this slide to get, for example, Davis, Weber, et cetera. Yeah. But when we're looking at the Wasatch Front, we just said, all right, what is the population dynamics historically, and what is the state forecasting for population growth? Again, this is all pre-COVID. And then based on that population growth, how much housing do we need to just keep up with the fundamental levels of demand? So what you can see right here is on this chart, Salt Lake County is estimated to be 1.3 million by 2030. And in order to keep up, we need about 4,000 housing units in the last half of the decade. We need 5,000 units between 2020 and 2025 per year in order to keep up, right? That's what it takes just for Salt Lake County. Utah County is growing at a higher percentage and about the same number of people on a lower base, but it requires the same thing, 5,000 units a year. So just Salt Lake and Utah County need 10,000 units a year of housing to keep up with population demand before COVID, right?
Yeah.
That's kind of our benchmark. And if we look at St. George, we look at Washington County. Washington County between 2020 and 2025 needs about 2,700 units a year. That's this number right here. 2,700 units a year to keep up with population growth pre-COVID. Now, that's the problem, is we were set for that growth. And for example, in Washington County, we were building about that. And now all of a sudden, you get a boost in demand. It takes time to shift supply into another gear. You can't do this fast.
And I'll say there's another thing that's happening is if you're a demographer, you're not going to want to overstate population growth.
No.
So
that probably isn't the best choice.
Yeah. So I would say that these numbers, even pre-COVID, were likely on the conservative side as opposed to the aggressive side. And then you add that second dynamic of COVID into it and the movement, and it's a change.
Yeah, that's exactly right. So now let's look at what COVID did in the context of a trend that was already in play, right? A trend towards moving people to Utah, Nevada, Idaho, Colorado, Arizona. There was already a trend in play. Let's look at what happened now.
I love this depiction. One of the things that's so amazing to me is a lot of times we think of Salt Lake as a pretty big market.
Yeah.
And Las Vegas is a big market.
We think, we're from St. George.
Yeah.
We think Las Vegas is a big market. We think there's a bazillion people on the Wasatch Front, all trying to move down here, which we're not unhappy about, by the way.
Yeah. And this tells the story. I mean, you look at Southern California, San Francisco, to a lesser extent, Seattle, the movement from Southern California to Utah,
it can be overwhelming, right? When you look at the size of that market relative to Las Vegas, Phoenix, a very small change in the Southern California market can have a big impact on Las Vegas, St. George, Salt Lake, Boise, and Phoenix all at the same time.
Yeah.
And I think that that's probably one of the biggest things that we're recognizing is if large employers who for more than 100 years have said, if you want to work for me, you have to live in a particular geography. If they're now saying you can work remotely, and if institutions of higher education are saying you can attend school remotely, right? Now I start to think, well, where do I want to live? And many people are saying, I don't want to live in a very small apartment on the 35th floor in a city that is a great place to live, but it's not where my family is, or it's not where I'm going to play and recreate, right?
Hang on. Can I keep my San Francisco salary and live in Beaver?
That's actually the point. Some people can,
right? Not every
and
case,
when that happens, all of a sudden everybody's saying, well, what is our next step? Now, here's the interesting part. That movement started this summer.
Yeah.
But that was only the people who could move immediately, right? What we're just going to find out in 2021 is there's a whole bunch of people who their employers are still making those decisions about whether or not long-term they're going to be remote or whether they're going to be moved back into their physical location. I think there's many more people that are going to find that they have the opportunity to move remote. And I don't think that this movement of people from large urban areas to more rural areas, and by the way, LA to Las Vegas is a rural move. San Francisco to Salt Lake is a rural move. Don't get me wrong, right? So moving to a rural area I think that shift is not ended with the, surge of demand we saw in the fall.
I'll say one other thing in regard to that. Northern Utah, the entire Wasatch Front for decades has put out hundreds of thousands of students and sent them all across the world.
Yeah, they have.
Everywhere.
Yes. And literally there's 200,000 students enrolled in higher ed on the Wasatch Front today.
Yeah.
And you're right, they've gone everywhere across the world.
And a key thing is when these individuals can choose where they want to live, they're going to want to come home.
Many of them want to
come back.
come
And a lot
back.
of them are coming to where they were raised, the Wasatch Front.
Yep. All right. Interestingly, what you're seeing here is this is state population growth between 2019 and mid 2020. So this really isn't even taking into account the real shifts that really occurred with COVID. But what you can see is that the Northeast and California have slowed, right? Their growth rates have slowed. Intermountain West is very strong. Boise has been just on fire.
Yeah, it has.
Intermountain West has been strong. Texas has been strong. Southeast has been strong. And that doesn't really come as a surprise because that's been the long-term trend. We just think that COVID is going to amplify existing trends. And that's really what we have seen so far. Another thing that's kind of interesting to look at is just where were job losses and where were jobs not lost. And in the Intermountain West, you see Idaho and Utah leading, where actually we had job growth year-over-year percent change from December 2019 to December 2020. Let me go back there.
During COVID.
During COVID, Utah and Idaho actually had job gains, whereas places like California, Nevada's not on this list, but they were definitely one that had significant job losses, right? They had job losses. And this is an example where public policy, it matters. It matters in terms of job creation or losses. And I realized that each state and each municipality had to make their own decisions about what was best for them. But it's really interesting to see this data and how it impacted the job markets in the markets that we're doing business.
Yeah, I think that can't be overstated, the impact that public policy has on population and on real estate values themselves.
Yep. All right. So let's take a look at next discussion, which is stimulus. Right. So we've been talking about policy matters, policy impacts economics, and we're going to be talking about a little bit of that at this point. So it's a lot of stimulus out there, Jono.
So we've had the federal government just pile a ton of money into the economy. We've got roughly $4 trillion when you take into consideration the next proposed stimulus from President Biden. And this money is sometimes getting to the right place, and sometimes some of it doesn't get to the right place, but really has an impact on who is succeeding and who might be struggling in this economy. But as you look at this here, you're noticing that through the PPP loans and through direct payments to households and several other things, there is a lot of money that's just being piled into the economy that isn't having zero impact. It's giving people purchasing power.
It's having an impact. So I'm just going to correct you. Sorry, John. You
Please.
said $4 trillion with the Biden fiscal rescue. We're approaching $5 trillion, 25% of U.S. GDP, right? And by the way, I think that this is really interesting because we look around and we say, well, how is this money being distributed? And there's all these programs and initiatives. And if you just did one really simple thing, if you said, well, there's a little over 100 million households in the United States, and we got $5 trillion, we're talking between $40,000 to $50,000 per household that is equivalent being distributed. It's not landed in people's pockets that way, but that's to give you some context about how much money the federal government is pushing through businesses, through state and local governments, through other programs and direct support, right? Through all these programs. It's a lot of money, and you can't push that kind of money without having an impact.
Yeah, there's no question. This is one form of stimulus that we're seeing. As we continue forward, there's the other type of stimulus that we're seeing is through interest rates. And this is a huge dynamic here. Everyone has seen the movement as we're talking about, how interest rates have changed. But as we look at a couple of things, the first one is looking at the 10-year treasuries. Now, we've seen just recently in the past several weeks a tick up in the 10-year treasury rates, but the long-term trend and the federal policy has been to lower the federal cost of capital over time. And that's having an impact in all areas of financing. It's having an impact on the stock market. It's having an impact in residential lending. It's having a big impact on commercial lending.
Before you go away there, I want to jump in here because I think this is really important. We've got a 40-year history of falling rates. I can't even tell you how many times we've said, rates are going up.
Yeah.
Rates are going up, right?
We felt like that's the only way they could go, and they keep going down.
They keep going down. And I think before we jump into these other two, I think it's really important for everybody to realize that today, even with this increase in the 10-year treasury off of its January lows, the United States 10-year treasury rate is higher than Italy today. Italy's
that
not
doesn't make sense.
Yeah, Italy's not exactly a bastion of fiscal responsibility.
Yeah.
And to be more pointed, Germany and France both have negative 10-year rates today. They have a negative yield on their 10-year rate. And I'm pretty convinced that the Janet Yellen and Ben Bernanke, they have some.
Jerome Powell.
They have. Thank you, Jerome Powell. I apologize. Yes, Jerome Powell, the Federal Reserve Chairman, Janet Yellen, who's now the Treasury Secretary, have rate envy.
Oh yeah.
Right. And Jerome Powell has come out and pointedly he's been very direct in saying, we don't want, and we're going to do everything we can to keep interest rates from rising. And I think they're serious about that because if interest rates go up, it makes it more expensive to essentially expand the money supply the way they have and for the U.S. federal government to borrow the way they have.
I think the question you're bringing up is, can rates go lower? And the answer is they are in Europe. There's somewhere to go.
And we're not saying rates will go lower, but I think that your point is absolutely right. It's a possibility, and we have to be aware of that. All right, let's talk about the SBA and 30-year fixed mortgage rates because they've followed a similar trend.
They have, for sure. So the SBA is for purchasing owner-occupied real estate. It's on the commercial side, but it's owner-occupied real estate for small businesses. If you look at this chart, so at the end of 2019, we dropped basically a point in 12 months, one full point, ending at about 2.7 or 2.6, somewhere right in that range. Also, if you look at the 30-year fixed rate, it did the exact same thing during the past 12 months, ending the year in December. And so when you drop interest rates by a full point on the commercial side, on the residential side, you have a phenomenal increase in purchasing power. Now, we talked about owner-occupied commercial real estate. We talk about residential home loans, commercial investment real estate, although you're not going to find necessarily the exact same rate. The same trend of rates dropping approximately 1% in 12 months is the same trend. And so all across real estate asset classes, we've had this massive increase in purchasing power just by the interest rate being reduced. And so, Neil, why don't you talk just about exactly how this works in a residential context, which isn't too much different than a commercial context as well?
Yeah, this is really an interesting sensitivity analysis. What we did is we said, well, for the average homeowner, how do these falling rates impact them? If rates fall from over the past 2 years, from 4.5 to 2.5, they got as low as 2.5, right? Then home values can increase 28% and your mortgage payment never changed.
28%?
Yes.
You'd think that had happened.
Interestingly, if you're at 3% or 3.5 and you go down from 3 to 2, or if you go from 3.5 to 2.5, 1%, that'll increase prices 14% if you want to keep your mortgage payment exactly the same. The reason why that number is so interesting to me is that in 2020, interest rates fell about 1%. Nationwide, home values went up 15%.
Yeah.
It's those exact numbers. Interest rates are having a huge impact on asset values in today's market. And so a lot of people say, boy, we're not going to be able to afford them. In a lot of ways, that's a very significant and very real concern. On the other hand, the interest rate policy has been, if you can figure out how to manage the down payment side, the actual monthly payment side is still manageable. There's one last thing that I think is really interesting about this, is that if you are a homeowner and the government lowers interest rates by 1%, even if you stay in your home, you just got a significant boost in equity, which is funding a lot of, for example, Home Depot's record year, right? And so home improvement projects are just wildly popular. And part of it is because if you are a homeowner, you just got handed a bunch of equity in a challenging environment.
Yeah, and even if you just go and refinance, you've got a few $100s every single month to go buy an RV.
Yeah, you could
go buy whatever you want.
Yeah, you could
people aren't traveling, and so where's that money go?
Yeah, you can refinance, lower your payment, and get cash.
Yeah, if you want.
Yep. So very interesting driver for some of the economic outcomes that you saw in 2020.
I think the key takeaway is federal stimulus is driving demand, is driving real estate values.
Yep. All right. We ready to go to the next one?
You got it.
Asset inflation.
So one of the key things we talk about the consumer price index. That's the most commonly used measure of inflation. Now in 2020, the consumer price index, which this basically measures, you see on the screen here, what they consider a basket of goods.
Here's our CPA basket, right?
Yeah, that's the consumer price index. So it's food, it's fuel, it's travel like airlines, it's used vehicles, right? The things that you would consume on a normal everyday basis. And so you look at that and you say, well, prices didn't hardly change. 1.4%, that's nothing. Well, if you start looking at the total cost of all items, let me just point out a couple of things on here. The first one at the very top, this one had the most inflation, used cars and trucks. That was about 10%. Now, I point out that one because a vehicle is not something that individuals typically purchase every year. Some people do, but it moves towards the area of fixed assets. And so when you start looking at fixed assets, so machinery and equipment, you start looking at structures such as buildings, any of these types of what we typically consider the larger, the most expensive purchases, we're seeing a lot of movement in prices. We're seeing a lot of inflation for these types of items. So in that regard, if you look at the S&P 500 or you look at the Dow and you say, well, how have, for example, the stock prices for these assets changed? How have commodity prices changed? You're going to see a lot different trend than what you're going to see typically than what's just measured in the consumer price index.
So I think as we look at this, consumption items, not much inflation. Assets, S&P up 16%, real estate up 15%, vehicles up 10%, right? We've got inflation. It's just not being measured in the basket that the federal government is reporting in the CPI. John, I know we've got a couple of other things here, and then we want to make sure we have time for our forecasts and questions. So let's just talk about a couple of other places where we're seeing a lot of pressure. This one is commercial real estate investment capital looking for distressed deals. There's a lot of money out there chasing deals.
Yeah,
and I think that this over 335 billion. This is a huge amount of money chasing deals in this market. In fact, that's one thing we hear a lot. Oh, I've got capital. I'm looking to buy and invest. Where's a deal? No deal.
Find one. It's hard to place the money.
No deals in the Wasatch Front.
Yep.
All right. Home prices. We talked about this nationwide. You can see this is the Case-Shiller. You can see that inflation right there popping, right? This is asset price inflation. We already talked about this. This is driven by interest rates and shifts in population in current market.
for sure.
Construction costs. This is a really important one, John.
So this is from Bonneville Builders, who's a builder in Utah and in Nevada. They're measuring from 2017 to 2020, basically a 20 to 25% increase in construction costs.
And that's across all classes.
All classes. So there's a little variation. You can see that, but the point is, CPI increase of 1.5% does not translate in what it costs to build a building.
That's right.
And it's getting more expensive. You'll notice multifamily, 27%, and housing costs are similarly on the rise with commercial structures.
And I think that also, it's not just one thing. It's not just lumber. We've heard a lot about that, or labor. It's permitting, entitlement, concrete. It's
all getting expensive.
Everything is getting expensive, right? So construction costs are way up. All right, John, forecast. Let's talk about what we think people should expect in 2021. This is the dangerous part of our discussion.
Right.
All right. So here's what we think. We think population growth is not temporary, and that we're going to see more population growth. More population growth, that's prices going up, right?
In Utah.
In Utah. We're talking about Utah right now, right? Lower interest rates. While we don't know that the interest rates are going lower, we think they could go lower. And if the federal government pushes interest rates lower, they're already buying the 10-year treasury, they're buying mortgages in the secondary market. If they keep pushing, right, they can push prices even further if they choose to. And we don't know what they're going to do, but they may.
Well, and right now they've said that they're going to keep rates at or near zero, the federal funds rate. So their policy, as stated now, is to continue to keep rates low.
Yep. We got a multifamily shortage. I mean, it seems like we just can't build that. That's pushing values up. Construction costs, pushing prices up. Stimulus and capital, right? Pushing prices up. We got a lot of pressure on prices in 2021. I think, John, maybe we should talk through some of these economic drivers because, as we look at this, I think one of our big takeaways is that much of what we're seeing is decision oriented as opposed to market oriented.
I don't think there's been a time in recent history where federal policy and state policy has had as much of an impact on real estate as in this cycle.
Yeah.
Now, meaning moving asset prices forward. And so if the federal government continues to push money into the economy, if they continue to keep interest rates extraordinarily low, though, if they continue to, impose restrictions related to COVID, all of those types of things will drive demand and drive values in the state of Utah. If they change their interest rate policy, if they stop the federal stimulus, and if they stop, and if everything goes back to normal with COVID, then it's going to have, then things aren't going to move as quickly as they will. The one thing that I would say in a caveat to that is that the shift of population from these large metro areas, specifically Southern California, to places like Utah, that is not going to change. And the reason why is even if COVID were to be all resolved tomorrow, people don't forget things that are life-changing.
We learned that about the last recession.
Exactly.
People have a long memory about difficult personal circumstances. And I think that's a really good point, John.
So, the people are making the decisions in their life based on what has happened, and they're going to continue moving to Utah. We talk about the office dynamic, right? Even if everything went back to normal, some people are still going to work from home.
Yeah.
So some of these dynamics, as we're looking forward, we just have to remember that even though everything could change tomorrow from where it's been and everything could go back to what we would call normal, people's memories are not just going to forget. They're still going to want, the flexibility of work and perhaps the ability to move to a place like the Wasatch Front.
So if we summarize these economic drivers, government decisions, so states open and close, federal government is going to be interest rate policy, financial stimulus, et cetera, right? Incentives to participate in remote work. demand, we're talking about, your concern is, well, this long memory that people have and how many more people will move than what was originally projected pre-COVID in those analyses we were looking at. And then we have supply constraints. You can't just take and double the number of homes that are being built in a short period of time. And so those supply constraints are going to create an environment, at least in 2021, where we think we're set up for rising prices. I think, John, with that, we're ready to take some questions from Roger. I know he's been keeping a few in the queue for us, and I hope they're not too hard, Roger. So you need to go ahead and unmute there, Roger.
There we go. Can you hear me now?
We got you.
Yes.
Oh, that
perfect.
is great. Okay.
Nope, you're back on mute, Roger.
There, am I unmuted?
You're good now.
Okay. If I was looking to invest in the Utah market in the next 2 to 5 years, what are the biggest risks that you see investing in the commercial market and in the residential market?
So you asked a stock pickers question. That's a tough one. Look, I think that I'm just going to give you a couple of thoughts. John can share his. As you're talking specifically about commercial, anything that can be shipped, then you probably need to be careful about, right? So if you're dealing with a product or a service that essentially can move online in the long term, you just need to be a little bit cautious about that. I think the hospitality and tourism are going to come back very, very strong. Drive-through is going to be persistently good. Anything that's consumer interfacing is going to be, people still want to meet and do business, but you're seeing a lot of your larger retailers, you're seeing a lot of your businesses where they can start to ship products that are moving, frankly, their retail space into industrial. So that's something to be aware of.
Picking the right asset class. That's a huge one.
I think retail is going to get better in some respects, but there's some aspects that you got to be careful about.
Yeah, I think I would add pricing. One of the biggest things is everything is getting a lot more expensive. So to acquire ground is more expensive, construction costs are more expensive, entitlements are taking longer. And so one of the key things is the cost every time you do a new development or every time you go to buy a new facility, the costs are getting more expensive. So the question is, speaking to commercial real estate, can the businesses sustain the new pricing that's required to get into the facility? And I think the underwriting on the commercial side of the business that's going into this space is a essential component, because if you go strong on pricing and the tenant is questionable or high risk, then your ability to then go and re-let to somebody else is going to be a little bit more challenging. Yeah. So underwrite the tenants extraordinarily closely to make sure you don't get stuck.
Yeah. Our philosophy has always been to find good assets that are in good locations in the way of growth. Yeah. And I think if you follow that principle, you're probably going to do well in Utah real estate market. So great question, Roger. What's the next one?
Okay, next question. If I was looking to invest into the Utah or Las Vegas markets, which counties or cities do you think would have the best opportunity for growth in the next 4 to 5 years along that whole front?
I think if you look at that analysis that we showed, there's growth along that whole area. And it's very difficult to say, well, if I buy this zip code or this particular asset, it's going to be the best performing. That's a really, really tough. That's a really, really tough one to pick. Las Vegas has long-term good fundamentals. It has a little bit more volatility than the Wasatch Front. St. George has good long-term fundamentals. At least historically, it's had a little bit more volatility, but it's also had really strong growth dynamics. And so I think that, when people are making those choices, there's a lot of individual preferences. Some people want to be close to assets. They like particular assets, whether it's curb appeal. I think picking in that regard gets really, really tricky. And so I wouldn't say, boy, you should buy in Davis County, but not Utah County, for example. I don't think that I would make a recommendation.
It's more individual and it's property specific than I think market specific. there's great opportunities in each of those markets.
We're seeing a lot of people be very successful in multiple asset classes in all of these markets.
And I would say that, us and our clients are making investments in all of these markets today.
Yeah. In fact, we've bought on the Wasatch Front, St. George, and Vegas in the last 12 months.
That's right.
That's great. Thank you. I've got another question here.
All right.
What are your thoughts on the lack of inventory across the country, including California, the Northeast, and the East? And how do our prices for real estate compare to those larger markets such as Los Angeles and Seattle area and Denver area?
Yeah, look, if you're not in downtown LA, then prices are going up. So if you're in the suburbs of LA, prices are going up. If you're in the suburbs of San Francisco, prices are going up. If you're in, as long as you're not in the downtown market. So if you're in downtown San Francisco, rents are down 15 or 20%, right? It's just the, and I don't know how to say that any differently. It's just the urban core, New York City, downtown New York City, rents are down 15 or 20%, but New Jersey, Connecticut, Westchester County, prices are all up.
But I think this question brings out another great point, and it's that real estate in Utah and Las Vegas is cheap relative to California prices on average. And so a lot of people are coming to these markets and they're saying, all right, this is the price. That's a great deal. I'm in. I could buy a new house for a lot less than my 30-year-old house in LA. And so, for people who've been in these markets for a long time, we're looking at it and saying, wow, look how fast prices are moving. It's starting to get more and more and more and more expensive. People coming from these other markets, and there's a lot of them, are looking at it and saying, this is a great deal. This is cheap. I'm excited to be here.
And I think you can use a really specific example. I might be in a 12 or 1,300 square foot house built in 1960 in Orange County, and it might be $800,000. And I can move to Utah or Las Vegas and buy 5,000 feet on a beautiful lot with views for the same price.
Yeah.
Very good insights. Thank you. I've got a whole bunch of questions rolling in here too. So next question, what do you think about sitting on the sidelines? What could change the market?
Sitting on the sidelines is really, really tough. And the reason why is we've talked about inflation. If you sit on the sidelines, you need to find a place for your cash. What you're really doing is you're shorting real estate markets. And we're not telling you not to do that. We're just saying that in this environment, it's really tricky because the stock market, you can choose not to consume or not to invest in stocks. But how do you not consume real estate? And the truth is you have to either lease real estate or you have to own real estate. And right now, the cost of leasing is going up as fast as the cost of prices, as fast as prices are. And so leasing ends up being more expensive than the debt that's associated with purchasing. And so it's expensive to short real estate. And again, we know people that are doing it, and they may end up turning out to be, this may end up playing out really well for them, but at least in the short term, it's very challenging because it's expensive to short real estate.
And I think a lot of people say, I want to take the conservative route. I want to take the safe route. I'm going to go to cash, and I'm going to invest when there's an opportunity down the road. The key is we don't know how long that time frame will be, and we don't know what the opportunities will be down the road. And so somebody who's going to cash today is taking a negative inflation adjusted return, and they're making hopefully making a conscious decision to do that. Yeah. And we're not saying one is better than the other. It's a matter of what your investment strategy is, and frankly, what the outlook on the market is.
I'll just add one other thing here, that homeowners in 2005, 6, 7 were highly over leveraged. And we recommend that people not over leverage their balance sheet. Talking about cash, Roger, if you're making investments, don't get over leveraged, because that amplifies your exposure to any change in market conditions. And we think that that's just a prudent, smart thing to be doing. Homeowners in this cycle right now don't appear to be over leveraged. Household balance sheets don't appear to be over leveraged. And so we think that's actually a healthy thing for the economy, but something to think about.
And this is advice that we always give our clients, and it's true today, and it was true 10 years ago and 20 years ago. and that is invest in assets that you can hold for the long term. You know, there's very, very few scenarios where it makes sense, you know, to go in and try and, you know,
flipping homes is like
just,
the 15-year fad in real estate.
yeah.
And it's not that easy in today's market. So anyway, I think that's really important, John, that you need to have a longer term investment objective. Short-term investment objectives are tricky right now.
Yeah.
Great, thank you. What is the ongoing impact of labor shortages, especially with the prospect of an increase in the minimum wage, perhaps a greater necessity of immigrant or at least an immigration? So
Yeah,
what do you think is
I
going
think
to happen because of these shortages?
Well, you're already seeing that the generals and the subs who need labor to help, produce housing and commercial real estate, et cetera, those rates are already going up. For most of them, the minimum wage is well below what they're having to pay for that labor today. And I think what you'll see is that they'll keep paying more until they get the resources that they need to build the products that there's demand for. So right now there's definitely inflation in terms of wages for good subs doing quality work. I think that that's really important. If you're doing good work, you're providing a high quality product, your prices are probably going up today.
And I would say that's also true on the basket of goods, the consumer price index that we talked about. So, keep in mind that the CPI, if wages go up, if there's a, federal minimum wage, or a lot of states, raise their minimum wage, it's also going to impact the CPI, which, it's going to cause additional inflation across the board.
So, we'll just have to see ultimately how that shows up, whether productivity will offset, wage increases. But ultimately, when you start talking about labor, there's a lot of demand for labor in certain sectors, and we're going to see, particularly as things open up, a lot of these gaps. For example, in California, we talked about that. Disneyland's eventually going to reopen, and they're going to need a whole bunch of people, and all those supporting businesses are going to go back to work.
Great, thank you. I have one more question for you here. We have an aging population.
All right, okay, home. We got it.
Good. So what do you think about multi-family senior housing opportunities?
I think medical in Utah is going to continue to be strong. And that includes senior housing, that includes hospital expansion, that includes medical demand for any type of medical services. So as far as looking forward in that regard, we look at the industrial market and we say the fundamental underlying dynamics are strong. The senior care market, the underlying dynamics are strong because population growth, especially for retirees who can afford to, are going to continue to move here in a pretty solid wave, and they already are.
Yeah, and one of the things I just believe is that we're it might not be entirely obvious, but people's discretionary income is actually expanding, and we see that because we can buy technology and multiple cars and TVs and all these things, right? That 50 years ago nobody had room in their budget to squeeze in, and one of the great discretionary expansions is medical.
Yeah, it is.
Thank you guys very much. And once again, Bank of Utah thanks everybody who was listening to this program today. I think that was very insightful to me. It's one of the better ones I've ever heard. So thank you so much. This program
thanks for having us, Roger.
Oh, yes. You bet. This program has been recorded, and so it'll be available tomorrow on our site, and also the slides will be available too. And once again, we appreciate you guys coming in and showing us the way of what we think is going to happen or what you think is going to happen in our marketplaces. And you know what? It's pretty exciting. Change is going to happen, so we might as well go along with it and take advantage of those opportunities. Once again, as Roger Christensen from Bank of Utah, thank you for listening. Thank you for being a part of our presentation. And with that, we're done.